Holy smokes, ladies and gentlemen. By crikey, we have some huge news today, and I can't believe what the Fed just said. I was laying in my bed with thoughts about the stock bubble going through my head when this huge news article came out. The markets are finally waking up to the huge stock market bubble that we're in. The markets are overvalued and a big correction is about to come. I actually did a video yesterday about the huge risks that are building up in the financial system, what caused the last financial crisis, and what's going to cause the next financial crisis. And funny enough, all the predictions I made in that video, the Fed just came out and confirmed them. But strangely enough, the algorithm didn't promote that video, but a lot of people said they absolutely loved it, so I'll put a link in the comment section because you have to know exactly what's going to trigger the next financial crisis. Alrighty, let's not waste any time, let's get straight into it. Look at this, everyone. This ain't no joke. Fed warns about potential significant decline in asset prices as valuations climb to sky-high levels. Listen to this. Rising asset prices in the stock market and elsewhere are posing increasing threats to the financial system, the Federal Reserve warned in a report Thursday. This is huge, everyone. Everything that we've been discussing on the channel over the past few months is now finally coming out. The Federal Reserve can no longer hide it anymore because it's so obvious to see that we're in a huge overvalued stock market bubble. It also says here future dangers arising. In particular, should the aggressive run on stocks tail off? Because what has been the story lately? Money print to go burr, interest rates are at zero, there's no other alternative but to go into the stock market. So this gave investors excuses to pay crazy high valuations for these stocks because there was no other alternative. But now with the talks of rising interest rates, if the bonds on the 10-year treasuries continue to rise, more investors may start to cycle out of stocks into bonds in order to chase yield. But it just gets crazy, everyone. Listen to this. So Fed Chair Jerome Powell and others have been asked repeatedly about whether they're concerned over rising prices. Well, Powell specifically has said that as long as interest rates are low, valuations are justified. But what's happening now? A lot of his colleagues are now starting to say it's time to taper and it's time to start lifting interest rates much sooner than they expected. Because this report notes that there is danger lurking should market sentiment change. So it says here, the reason asset prices are so high is because the low yield on the 10-year US Treasury. But if that starts to rise, these high growth, high PE tech stocks, they're going to absolutely plummet. And that's what's already been happening. A lot of these retail investor stocks, which a lot of the financial YouTubers have been pumping up, they've been plummeting. However, even though treasury yields are low, it says here, valuations for some assets are elevated relative to historic norms, even when using measures that account for treasury yields, the report states. So even with the 10-year treasury so low, the stock market and even the housing market is still significantly overvalued. And guys, many of you may not know the significance of this, but this is huge what's going to happen with the banks. It says here, she specifically mentioned that having banks increase their capital requirements during economic expansion as buffers against a downturn. So what are we having with the banks and the hedge funds and what I've been talking about? There's a great deleveraging happening. And we all know this is a debt-based economy. So if debt goes down and if leverage go down, because the only thing that's been lifting the stock market to crazy highs is huge amounts of leverage and derivatives. And also another huge finding in the report, it says, the report also mentioned risks at hedge funds and other non-bank financial institutions on several occasions as potential threats to the system. And this is what I went over in my video yesterday, so definitely go check it out. I've been talking about the derivatives, how if one big hedge fund goes down, one bank goes down, even if it's not one of the majors, it will send domino effects throughout the whole financial system, like when the insurer AIG defaulted and Lehman Brothers defaulted in 2008. And also something huge that's happening in the markets right now is before in 2020, it was a risk on environment because of all the money printing and all the devaluation of the dollars, and the US 10-year treasury fell down to 0.5% and stocks were at a lot better values. But now we're starting to go into a cycle of a risk-off environment. Listen to this. Combination of stretched valuations with very high levels of corporate indebtedness bear watching because of the potential to amplify the effects of a repricing event. So what happens with the stock market is it's always forward looking, and it tries to predict what's going to happen in the future and price in events before they happen. So right now we've seen companies absolutely smash earnings, but their stocks are still plummeting. That's because the stock market already priced it in, but now the stock market is starting to price in higher interest rates and higher inflation. So the Fed also talks about what I've been talking about, how the money market funds completely froze up and are broken. They broke in 2019 and they broke again in 2020. The Federal Reserve had to bail it out because everyone did a run on the money markets. There's not enough liquidity in there, so the Federal Reserve has to go up and buy everything. It says here the Fed also talks about potential threats from the money market and open-end funds. The Fed goes into a few specific scenarios that show potential risk to the system. It specifically talks about what I've been talking about, Archego's capital management episode, where the firm could not meet margin calls, causing several large banks to take big losses. And what I've also been talking about, margin debt is at all-time highs. So you better believe the big banks are calling up all their clients to make sure they haven't cross-collateralized like Archego's, and this did cause huge panic, especially for Jerome Powell, but most people don't realize how much issues this could have caused. And this is very alarming, everyone. Listen to this. While broader market spillovers appeared limited, the episode highlights the potential for material distress at a non-bank financial institution to affect the broader financial system, the report said. So like I said earlier in the video, all it takes is one institution to go down to cause a domino effect and a ripple effect throughout the whole financial system. And also in this report, it goes on about the $1.7 trillion in student debt and how that poses a risk to the economy, because a lot of people, a lot of the high earners have a lot of student debt. So if they're putting all their money to pay off debt, well, first, paying off debt is deflationary, so they don't like that. They want people taking on more debt. And secondly, that means a lot of their income is going to pay off the debt instead of spending it on goods and services. Alrighty, now the moment we've all been waiting for in the report. What does it say that are the biggest risks to the financial system right now? Well, first things first, obviously the pandemic. If that thing gets worse, all bets are off. Things are going to come crashing down again. But some other more realistic or more likely events that are going to happen, it states here. So the first risk, it says, is rising interest rates. And we all know there's been talk of rising interest rates to get inflation under control. And it's not going to take a big increase in interest rates for prices to come plummeting down. Just a 1 or 2% increase in interest rates will be enough to cause significant correction in the markets. And if it goes above 2%, we're going to see a full-on stock market and housing market crash, because that means people won't be able to afford their margin debt anymore. They're going to be paying off their margin debt, which again is deflationary and will take money out of the markets. And for the housing market, these big hedge fund institutions that are going out there and buying up all these single family homes, because people, normal individuals, can't afford houses anymore. So you're getting these big hedge funds that are buying up houses, single families, in the thousands. So even though in the US interest rates are fixed for 30 years, your house is only worth what another potential buyer is willing to pay. So if their borrowing power gets reduced by 30% and people are overpaying 30% right now, there's going to be some big pain for the housing market as well. So thirdly, it also goes over another risk, which is rising inflation, which we're all seeing. Commodities are skyrocketing, energy is skyrocketing, food prices are skyrocketing. Everything that's mandatory, essential, is going up in price, while non-discretionary items are falling in price. But at the end of the day, all the things you need to survive are skyrocketing. So some people say, look, all these things are deflationary. The non-mandatory items are deflationary, but the mandatory things are going up very close to hyperinflation. And still another big risk. This was all the talk in 2019. This was all over the media, that this was going to be huge for the markets, but the markets completely forgot about it. And all the YouTubers aren't really talking about it. And that's a huge US trade war with China. If this continues to worsen, you better believe it's going to be more pain for the markets, and hopefully it doesn't escalate further. It says here, Fed's Rosengren says conditions for tapering could be reached later this year. So the Federal Reserve and even the RBA, the Reserve Bank of Australia, they're all been saying, no, we're not going to think about lifting interest rates till 2023, 2024, when the markets don't believe them whatsoever. They're not buying it and the public don't buy it. And also his colleagues don't buy it. And that's why the Fed created 12 other central banks, so that it won't be so centralized. It still is a lot of centralized power, but there are actually 12 other central banks in the US. And the Dallas Fed chair, Kaplan, says it's time to start talking about tapering and lifting interest rates. And we also heard Janet Yellen. She's getting a bit old, maybe a bit of dementia there. She accidentally slipped out that they're going to be rising interest rates, but then the market started selling off and she had to bite her words. She had to take back things instantly. She literally says all this stimulus is going to cause rising interest rates. And then once the markets started selling off and they called her up and said, "What are you doing, old lady?" She's like, no, I didn't say that. I didn't say that at all. Come on. It was on video. So everyone, it's time to start looking at your portfolio. Unfortunately, what's going on in the YouTube finance space is these YouTubers are promoting a lot of these retail high valuation tech stocks. But with rising interest rates, these tech stocks are going to get smashed, and they've already been getting smashed. But what has been performing very well that not many people are talking about, and what I've been talking about, which continues to outperform the stock market, is commodities. Look at this, everyone. So this is the Invesco DB Commodity Index Tracking Fund, DBC. And as you can see here, over the past year, it's been absolutely skyrocketing. And just year to date, it's had a return of 25%, absolutely smashing the S&P 500. This is a commodity index that diversifies across multiple different commodity sectors. But there are also some more specialized commodity ETFs that I like, and we'll have a look at them. So another commodity index that I'm very bullish on is the Invesco DB Base Metals Fund, DBB. This diversifies across the industrial metals, and industrial metals like copper, silver, palladium have been skyrocketing as of late, and I am bullish on them in the future with the renewable energy boom and with the EV boom. And look at this chart, everyone. Commodities are very undervalued and people are completely overlooking them and underestimating them. This commodity index for the industrial metals is still lower today than it was in 2007. In 2007, it was $27. Today, it's only $20. Again, going back to the DB Invesco ETF, that's where it diversifies across multiple different commodity industries. That was $44 in 2008, and it's just $18 today. That's more than a 50% discount you're getting. But the stock market is at all-time highs, and the housing market is all-time highs. Gold is close to its all-time highs, and Bitcoin is close to its all-time highs. The only asset class that is still undervalued today is commodities. But that's not all. I'll show you even more. Now, have a look at this, everyone. This is an agriculture commodity index. So if you're bullish on the price of food going up and you want to hedge against your grocery bill going sky high, it may be a good idea to have a look at this. Again, not financial advice. This is just what I'm doing to hedge my positions. Invesco DB Agriculture Fund, DBA. Again, look at its prices today compared to its all-time highs in 2008. It was $41 in 2008, and it's down to $19 today. Even with the bull run that we've had over the past year, there's still lots of room for the commodities to run in 2021. Okay, now another hedge against the inflation coming, and something that's not correlated with the stock market, is precious metals. Now, if we look here at the chart of gold, gold is still down from its all-time highs, but it's not that discounted. It is still pretty close to its all-time highs of around $1,950. But something that is huge, what some people may not be aware of, silver is significantly undervalued. It's $27 today US, but have a look at this chart. It actually reached $50 or close to $50. It reached about $49.40 over here in 2009. So again, silver is down almost 50% from its all-time highs, and it's lower today than it was in the 1980s. That's right, in the 1980s, it reached around $35. So when you factor in inflation of around 3% per year over 40 years, silver should be at least $100, just in my opinion. Now, of course, if we look here at the chart of Bitcoin, Bitcoin is down a bit. It would have been good if you could have brought at $47,000 on April 26th. But again, Bitcoin is close to its all-time high, so it's not at a much of a discount compared to commodities, and it is very risky. I am very bullish on Bitcoin in the long term, but it's just so hard to value. And normally 18 months after the halving, we enter in a crypto bear market. So if we do enter another bear market, I will be loading the boat on Bitcoin. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you all updated on the latest that's happening in the stock market, the housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you there.